Welcome back. So in today's video, I'll be talking about high quality stocks that are trading at their lowest valuation. So in today's video, I'll be covering a few things. We'll be covering all these stocks, my goals, as well as some questions left in the comment section below. So let's talk about 52-week low stocks that look great today. And the first stock that I'll be talking about is United Health. So United Health year to date is down around 40%. It's currently trading at a 13 times earnings, giving you around a 3% dividend yield. So for United Health, here are some of the headwinds for the business. So United Health is facing multiple investigations and lawsuits related to potential Medicare fraud, particularly concerning its Medicare Advantage business. The DOJ is investigating the company for possible criminal Medicare fraud, while civil lawsuit claims that United Health improperly overcharged the government by billions of dollars. So this is one of the headwinds for United Health today. But if you were to look at the history of all the different Medicare fraud claims, Humana had a similar case last year as well, and they were let off with a fine. So for all these different insurance companies, they're extremely important for the citizens in the United States. So it's hard for the government to completely displace all these different insurance companies because it will affect the livelihoods of a lot of people in the US itself. And that's why you're seeing cases like this being let off with a fine. So for United Health, I think the Medicare Advantage fraud case is slightly overblown. The stock dropped around 20% because of this case itself, and we could see the stock recovering soon as well. And the other headwind for United Health is that they are reducing Medicare Advantage enrollments. This is the one that I feel is more concerning for the business. It could signal that the company is structurally unsound. So United Health nixes many Medicare Advantage commissions. United Health Group will cease paying commission to brokers who enroll new beneficiaries into nearly 200 Medicare Advantage products in 39 markets. The company notified third-party sellers on Monday. So less commissions for the brokers means less enrollments, and less enrollments means less top-line growth for the company and increased cost-cutting measures. So this is what the new CEO is doing. He's doing the opposite of what the old CEO did. So Andrew Whitty, the old CEO, what he did was he took in a lot of people to increase the top-line growth, but this hurt their bottom line because a lot of the people that they took in were very low quality. So for United Health, if you were to look into the valuation itself, United Health is currently trading at a 13 times earnings. So the average over the past 10 years is around a 23 times, the median is around a 21 times. So for United Health, the valuation itself is far off its average. So if we see some form of mean reversion for this stock, it could be extremely bullish for shareholders today. So for United Health, I think buying this company is buying a strong turnaround company with historically good metrics. The company has been compounding for many years already, and with their new CEO, Hemsley, they will likely turn this around. So for Hemsley itself, he was the ex-CEO of United Health during the Obamacare period and the Great Financial Crisis period. So besides being an extremely good CEO, Hemsley also recently bought $25 million worth of United Healthcare shares. So this is signaling some sort of confidence from his side. And for United Health, I see it as one of the best opportunities in the S&P 500 today, although it is a speculative one and a slightly risky one. The next stock that I'll be talking about is Canadian National Railway. So Canadian National Railway this year is up around 1%. It is currently trading at a 19 times earnings, giving you a dividend yield of around 2.5%. Over the past 5 years, the stock has actually been flat. So there's been a lot of bad sentiments for all these railway stocks because they're often seen as boring businesses, along with earnings depression. And this is what Bill Ackman actually said about railway companies as well.
Railroad business is one of the great businesses of the world. Why is that? Well, first of all, they're not going to build a new one. Right, if you own the second largest railroad in Canada, this is an asset.
That was what you, yeah.
That's Canadian Pacific. It's an asset that was created 150 or 60 years ago, and you had to, the government granted a bunch of land, and the replacement cost of the railroad is, hundreds of billions of dollars.
And it's cheaper to ship by rail than it is by plane.
That's right. It's more efficient.
Right.
It's more efficient. It's better for the environment. If you think about the trucking, shipping by a truck, the taxpayer pays for the infrastructure, right? The roads are taxpayer expense. In rail, the railroad pays for the infrastructure. The railroad pays for the rail and the ties. So it's good for governments running out of money. It's good for efficiency. It's good for the economy.
So for railway companies, they are natural monopolies because the startup cost for you to become a railroad company is simply too high for you to even compete in this space. So for all your railroad stocks, they're extremely predictable. They are cost efficient, and for your railway companies as well, they're projected to have around double-digit growth for the next 3 years. So for example, Canadian National Railway is projected to have around a 15% EPS growth this year. And for railway stocks, they will stay around for a very long time because for railway companies, they have significant cost advantages for long-haul freight as compared to air freight and trucking as well. So they're seen as fuel efficient and they have greater labor productivity per ton mile as well. So your railway companies, they're actually quite high quality. Even Warren Buffett owns a railway company in his entire suite of companies. he owns BNSF, and great investors like Chris Hone, even Bill Ackman as well in the past, they own high quality railway companies because they're predictable, they won't be displaced, and they're almost undisruptible. So for Canadian National Railway, it is a company that will not give you overwhelming outperformance, but it is a company that will give you stable 10 to 15% returns every single year. The stock is depressed now due to US and Canada trade relations, but it will likely ease in the future. Analysts are also projecting higher growth for all these companies. So along with earnings growth, there will be some form of multiple expansion, which could give you decent returns from now till maybe a few years' time. Next stock is LVMH. So LVMH year to date is down around 30%. It is currently trading at a 17 times earnings. So for LVMH, the good thing about the business itself is that it owns a lot of the real estate that it operates in. So for LVMH, if you have to look into their balance sheet itself, they have a lot of properties under their property, plant and equipment section. So for LVMH, at market value today, they have around $70 billion worth of real estate. So $70 billion out of around $200 billion market cap is around 1/3 of the market cap itself already in hard assets. So there's a price floor when it comes to buying LVMH stock. You're basically ensured that you won't lose more than this real estate amount. So for LVMH, they have amazing leadership as well. So Bernard Arnault has been with the company for quite a while already, and his capital allocation skills has been quite decent. So Bernard Arnault is extending his retirement age again to around 85 years old. He's currently 76 years old, so that is around 9 more years of Bernard Arnault. Under his quality leadership, LVMH will continue being the company that it has always been in the past. So for LVMH, from a valuation perspective, the company is trading at a historical low valuation. So over the past 5 years, the company has never traded at this low of valuation. And the last time it traded at this valuation itself was in around 2018, when Trump had a tariff debacle as well. So we're currently seeing something similar in terms of the valuation. And for LVMH, the risk with the company itself is simply just the Chinese consumer weakness. So China's luxury market has been declining over the past few years. It saw a parabolic growth from 2018 up to around 2021, and since then it's basically returning some of that growth itself. So it is impossible for you to predict how the Chinese luxury market will perform, and for LVMH, they derive a significant chunk of their revenue from Chinese consumers, so that could be a headwind for the business as well. So for LVMH, it is a decent company with a management that is top tier, almost the Berkshire of luxury. The company is cyclical and has experienced this sort of downturn in the past as well, which it has recovered from. It won't be high growing, but it is a stable business to own. And especially today at a 17 times earnings, I think this company is one that is super interesting. And I think for a quality business like LVMH, it definitely deserves a much higher valuation than it is today. Next stock is AMAT. So AMAT in the past year is actually down around 22%. It is currently trading at a 22 times earnings. So they have a significant portion of the market share in a lot of these different segments in your. So they have a significant portion of market share in a lot of these segments over here. And for AMAT, they are seen as sort of like the jack of all trades in your wafer fab equipment section in your semicon industry. So for AMAT, the fundamentals are quite decent as well, although it's a bit cyclical, but the trend long term is up. Besides that, the metrics are quite good as well. So ROIC of 20%, ROC of 32%, ROE of 36%. It is a quality business with quality metrics as well. So for AMAT, the valuation itself is also quite depressed as compared to its peers. So if you have to look at ASML, Tokyo Electron, Lam Research, Applied Material, KLAC, as well as SUSS, AMAT actually has one of the lowest valuation as compared to its peers. So for AMAT today, I think it is a strong company that is trading at a decent valuation today. It is still its 52-week low as well. So let's see how that one plays out. Next portion, I'll be covering some of my goals. So for my investment goals, I would like to stay completely rational and unaffected when the market falls. I would like to buy high quality companies that are predictable and avoid fads and speculation. I would like to reduce my portfolio activity as well. But the more important one that I'll be talking about is my YouTube goals. So thank you so much for subscribing. I have around 2,400 subscribers today. And here are some of the things that I want to achieve with this YouTube channel. I would like to create higher quality videos. Please feel free to leave me any feedback on my videos itself. I would love to improve on them. I would like to continue pushing for sensible videos rather than pushing speculation for views. I would like to stay with my principles as well. So I don't want people buying into terrible hype stocks, so I won't be posting on them as much. And for this YouTube channel, I would like to thank you guys for subscribing. I'll continue pushing out videos, and I would like to increase the quality of the videos itself. Last portion, I'll be talking about some questions left in the comment section. So the first one, it says, I want your perspective. Why do you decide to invest into REITs compared to banking like DBS, OCBC, UOB in Singapore? So DBS, OCBC and UOB, they are earning elevated earnings currently because of the high interest rate environment. So when your interest rates are high, your banks, they typically benefit the most, and your REITs, they suffer the most because your REITs, they need to borrow money to basically buy property. So for DBS, OCBC and UOB, they're currently having tailwinds today because the interest rates are high. But if the Fed normalized the rates to around 3%, then you will see DBS, OCBC and UOB having a year of declined earnings as well. As for REITs, I view them as predictable businesses with predictable stream of cash flows. They're not super high growing, they're not super high quality, but they're predictable businesses that will give you around 10% returns every single year. And for a lot of them, they're currently massively undervalued. So that's the reason why I'm holding a lot of the REITs today. Next comment, it says, Warren Buffett has many reasons separate from just thinking market is high to hold cash. He has a concern Kamala Harris would win the election. He discussed this as a risk and wanted to take gains prior to that. A huge percentage of his portfolio was Apple, which is a large chunk of his cash. Apple was a great trade and the dynamics have changed. He bought them at a low PE when the company was growing quickly. It is now at a high PE and it's not growing. It was time to get out. He's handing the trading down and wanted to give the new people cash to decide what to invest in. They've been gun-shy justifying cash because it is getting a yield. I see this as a huge mistake. I think holding too much cash because Warren Buffett could be a large mistake and it's just a good excuse to be too fearful. Between Trump's spending and the advancement of AI, the market is not as overvalued as it may seem. On top of that, the markets are pricing in 5 to 7 rate cuts next year, which should stimulate the markets as well. I'd be more cautious of a melt-up than a market correction. So a few things, everyone is genius in a bull market. It sounds smart after the 20% rally that we had, and it is convenient to say this after the rally that we just had. But this is my perspective. Similar to what Warren Buffett does, I can't find opportunities in the market today that is compelling enough for me to bang the table to buy into the stocks. I'm not just going to buy stocks for the sake of buying stocks. I want to buy stocks so that I can get returns over time. And currently now I don't see many companies providing this opportunity apart from small caps as well as some Chinese stocks. So holding cash is a mistake in the long term, but currently now there isn't much opportunities in the market. And as for the market, it's not being as expensive as it seems today. It is historically and objectively expensive. So only time will tell us whether or not the markets are cheap or expensive today. I hope you guys have found this one useful and invest safe.